Alec Walker, Managing Director of Financial Planning at Crestmont Private Wealth in Houston, joined by Sam McGee, CEO and Chief Investment Officer. So Sam, we've been having both been having conversations with clients regarding many of the same topics. Thought it'd be helpful to provide some insight around these major hot button issues to start the year. This has been a pretty unique year. Historically, stocks and bonds have moved in opposite directions, but to start the year, they're both down. So my first question that I've been hearing is, with stocks and bonds both down, why should we not go to cash?
It's a great question. First off, yes, definitely an acknowledgement. This is a very unusual year. We have to go back to 2018, last time we saw something kind of like this, where the highest performing asset class was actually cash. But let's remember, we are not even halfway through the year. And when we take a look at cash as an asset, we do believe that every client should have an emergency fund bucket. That's important. But when it comes to long-term investing, we believe that going to cash is either a market timing decision, which can work against investors, or if you're going to cash long-term, it can really work against investors by eroding against inflation. This quilt chart right here kind of illustrates that. If you take a look at the different asset classes, this is in the US over the last decade, it's really tough to pick a pattern. You take a look at commodities, which have been in the headlines the last year or so, they have performed exceptionally well. But if you take a look at 2012, 2014, 2015, or even 17 through 19, we're one of the laggards. Other asset classes as well are either up or down. And so maintaining a very well diversified long-term portfolio, we believe, is prudent.
And I think somebody that's working that still has income coming in can withstand the volatility a little bit easier. It's easier to have that long-term mindset. But for clients that are retired, which many of our clients are, common question is, hey, I need to live off of my portfolio, but I don't want to sell any of these assets at a loss. What can we do?
That is a fantastic point, Alec. We see sort of a mindset switch when people do retire. When you're working, you're very focused on what you're doing day to day, and you do have that income coming in maybe every 2 weeks or semi-monthly. And so when you go to living off your portfolio, it's a completely different deal, a completely different mindset. And that can sometimes work against investors because their psychology can get the better of them. We do believe that you can't time it perfectly when you're raising capital off your portfolio in retirement, but a fiduciary and a fiduciary mindset, you can do things to mitigate the effects of the down bond market and the down stock market. If you have a very well diversified portfolio across a number of different assets, you can simply choose the lowest impacted assets first, or you can take a first in, first out method to have a more rebalancing effect on the portfolio over time during depressed markets. But we do think that, back to the psychology, you've got to zoom out a bit and decide, are you making a decision or feeling a certain way based off of recent market events and anchoring off a recent high on an asset price, or are you not? And so zooming out, taking a look at what the market has done long term, I think is important.
Yeah. And I think the important thing that you mentioned and that we always emphasize is the investment strategy is built on top of the plan. So having that financial plan and income plan in place can help in these very unique market events. So third and final question really has been the biggest topic over the last year or so. Inflation is high, and it seems like there's no end in sight on the rising prices. What can be done in my portfolio?
It's a great question. This is one that we get a lot of questions on from clients, and certainly we've got a wide spectrum of clients in their 20s up into their early 90s, and so the experience of inflation is very different for each investor. But I do know in the 70s and 80s there certainly was pretty high inflation. I was out on my BMX bike and at the park. But we study it and we know what the Fed does. And, the Fed's job is, to attempt to maximize employment, stabilize prices, and moderate long-term interest rates. And I think they're doing a great job of that. It doesn't feel good when they raise rates or they're expected to raise rates and what it does to the market. but they're doing their job. And I think we have to, take stock of that and realize that that is the way to curb inflation. We just had massive stimulus post-pandemic, and something has to be done about it. If the Fed doesn't raise rates, we could see runaway prices go even worse. So I think they're doing their job. That is somewhat of a comforting message, but I think time is what we need. We need to see the effects of time of the Fed doing their job. And the other thing to remember too is the high net worth investor and the affluent. Reality is they have a portfolio that is going to have the ability to have a natural hedge if they have an allocation to equities to be able to offset some of this inflationary effect. So equities or stocks typically have been a nice natural hedge to inflation because companies can raise their prices. Now, that's something that can happen over time. And we believe that equities are still a great natural hedge. So maintaining a component to equities, we believe, is prudent and the right course of action. However, those that are at the pump that are also going through grocery line and seeing the effects of inflation right now that don't have that portfolio, that's a tough pill to swallow.
Yeah. It's important to remember that, we look at these investments on a piece of paper on our statements, but we're ultimately investing in those underlying businesses. And those businesses are adapting to changing environments to remain competitive, to survive. And so we want to create a portfolio where our clients are going to benefit from those positive business results as illustrated here on this chart. Thank you very much for watching this video. Sam, thanks for your commentary. I'm sure there'll be many more unique questions as the environment changes.
Thank you, Al.